Welcome to the Explainer. Today we're diving into a fundamental analysis of Sterling Infrastructure, ticker symbol STRL. We're going to look at how this traditional, heavy construction company has managed to completely pivot into the artificial intelligence infrastructure space. And to figure out if their current valuation actually makes sense, we'll be running the stack through the legendary analytical frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, right alongside a rigorous discounted cash flow model. Let's get into it.
So here is the multi-trillion-dollar question. How do you profit from AI without just blindly buying chip stocks? You see, finding real value in the AI sector usually means looking way beyond the primary semiconductor designers and software developers. We need to look at the secondary wave of capital expenditure, the actual physical infrastructure build-out. By evaluating Sterling Infrastructure through these classic value investing lenses, we're hoping to strip away all that noisy market narrative and see if the underlying fundamentals actually support an investment case here.
All right, let's kick things off with the Warren Buffett lens, starting with the concept of an economic moat. So what does Sterling actually do? Well, they literally move the dirt. They handle site preparation and foundational infrastructure for massive hyperscale data centers. This is incredibly specialized, mission-critical electrical and mechanical work, which inherently creates high switching costs and major barriers to entry. Being able to deliver on these complex, large-scale industrial grading projects gives them a real degree of pricing power. And that's absolutely crucial for Buffett when he's looking for a durable competitive advantage.
Okay, moving right along to Section 1, Blowout Q2 2026 Financial Results. Let's evaluate their recent performance using Benjamin Graham's Defensive Investor Checklist, where we're really looking for adequate size and a rock-solid financial condition. Check this out. GAAP revenues hit $1.168 billion for the quarter. That is a massive 90% year-over-year increase, and get this, 50% of that growth was generated organically. Meanwhile, adjusted earnings per share skyrocketed 116% to $5.80. For Graham, this proves the earnings stability he demands, while that kind of significant margin expansion totally satisfies Buffett's preference for a high, consistent return on equity.
Now, what about management effectiveness? That's another core Buffett criterion, and it means we have to look at how they execute against their own projections. Well, management just raised their full-year 2026 guidance. They're now projecting adjusted EPS between $19.70 and $20.30, along with an adjusted EBITDA of up to $916 million. That's a 70% year-over-year growth in adjusted EBITDA. This translates into highly predictable, growing owner earnings, which tells us management is doing a fantastic job allocating capital in the near term.
Which brings us to Section 2, the E-Infrastructure Pivot.
If we apply the Peter Lynch framework here, we need to categorize the company based on its growth dynamics. Historically, Sterling was your classic cyclical builder, but today, they're showing all the hallmarks of a fast grower or a wildly successful turnaround story. Just look at the numbers. E-Infrastructure segment revenue exploded by 192% year-over-year. At the same time, their legacy building solutions dipped 1% and transportation solutions dropped 20%. They are intentionally reallocating resources toward that higher-margin E-Infrastructure business. It dramatically changes their earnings trajectory, meaning we have to completely rethink their PEG ratio to account for this targeted, accelerated growth phase.
But, there's always a catch. This shifting revenue mix introduces some very specific risks that we have to account for, especially under the Benjamin Graham methodology. Right now, 78% of their revenue is basically one big bet: hyperscaler and data center projects. Sure, it's a high-growth sector, but that kind of heavy customer concentration inherently ramps up the risk of a cyclical downturn if, say, major tech firms suddenly decide to slash their capital expenditures. For a strict Graham investor, having that much singular end-market exposure means you either need to apply a much higher discount rate or demand a significantly wider margin of safety before you'd ever consider initiating a position.
Let's shift our focus to the future. In Section 3, a massive contract backlog.
When you're building a discounted cash flow or DCF model, the absolute hardest part is accurately forecasting free cash flow, right? Well, Sterling has a signed backlog sitting at $4.3 billion. That's a 116% year-over-year increase, and it gives us the incredibly high confidence visibility we need for the first 3 to 5 years of our DCF model. And if you factor in unsigned awards and future phase opportunities, the total addressable pool jumps to $7 billion. That allows us to model those near-term cash flows with a remarkably low margin of error.
Returning to the Buffett lens for a second, the actual composition of that backlog is just as important as the big dollar amount.
Over 92% of their e-infrastructure backlog is tied directly to mission-critical projects. We're talking advanced manufacturing and massive semiconductor campuses. Because these are long-term, multi-phase mega projects rather than just quick, short-term jobs, they secure exactly the kind of consistent, highly predictable owner earnings that Warren Buffett absolutely prizes over a 5 to 8 year horizon.
Now let's get into the debate over their current market cap in Section 4, Valuation, Bull versus Bear.
Running a base case DCF model really highlights the massive divergence in current market expectations. On one hand, a conservative bear case gives us a fair value of $211 per share. This assumes a higher weighted average cost of capital, or WACC, and models a pretty sharp drop-off in terminal growth around 2028 due to hyperscaler digestion. On the flip side, a bull case DCF, using a lower WACC and a higher perpetual growth rate, models free cash flows compounding all the way to $1 billion by 2031. That spits out a $555 per share valuation. Running a standard sensitivity table on the WACC and terminal growth rates confirms it. This valuation is highly elastic and totally depends on just how long this infrastructure supercycle actually lasts.
If we evaluate the stock through Peter Lynch's criteria, we hit a pretty notable headwind. Institutional ownership sits at almost 81%. Lynch typically hated seeing that, as it usually means the stock is already widely discovered and crowded. However, if we shift to comparable company analysis, Sterling's forward PE ratio of 24.36 is actually trading at a relative discount compared to direct infrastructure peers like MasTec and Quanta Services. To cross-reference this, we'd apply Benjamin Graham's intrinsic value formula, the square root of 22.5 times earnings per share times book value per share, just to see if the current multiple offers any mathematical margin of safety, completely independent of those wild future growth projections.
So let's synthesize all these methodologies to get our final valuation overview. Peter Lynch might avoid the stock right now because of that elevated institutional ownership. Warren Buffett, on the other hand, would likely love the deep economic moat and the clear visibility into long-term owner earnings. But Benjamin Graham, he would absolutely demand a wider margin of safety to offset that 78% customer concentration risk. When you weigh our base case DCF fair value against comparable sector multiples, the data really points to a hold at current market premiums. For the strict value investors out there, a targeted buy trigger would likely sit much closer to that Graham-calculated intrinsic value, giving you some structural downside protection before you underwrite the multi-decade tailwinds of AI infrastructure. Thanks so much for joining us for this explainer.